Out as well, China's state-owned companies continue to expand their footprint in Australia's mining sector. China Railway Materials Commercial Corp has agreed to fund 2 Australian iron ore producers in return for supply contracts. The companies involved are Ferroz and United Minerals. Meantime, junior iron ore miner Atlas Iron also says it is in talks with prospective Chinese investors. Separately, power producer Guangdong Nuclear says it will buy up to 70% of energy metals. That's an Australian uranium explorer. Let's get more now with Dariusz Kowalczyk. He's Chief Investment Strategist at SJS Markets. He joins us, of course, from Hong Kong. Dariusz, good to see you again. Listen, we know for a long time that China has been very interested in the Australian resources sector. As we begin to see things sort of begin to heat up a little bit here with the interest, are we going to see more deals structured at a lower level, at a smaller level like this, rather than a much bigger Rio Tinto, Chinalco type of deal?
This is exactly what's likely to happen. China obviously is very hungry for commodities and is trying to secure long-term access to both energy and metals, but it has run into obstacles, mostly of political nature, both in the US a few years ago and recently with Rio Tinto in Australia, as those countries really do not want to cede control of their strategic assets to an upcoming competitor. That's why Chinese companies are going after smaller companies right now. They're having more luck here, but still the Foreign Investment Review Board of Australia is quite hostile to actually allowing Chinese companies in. So I think that they will come in one by one, targeting smaller companies, not necessarily through ownership takeover, but funding projects in exchange for long-term supplies, like some of the deals announced today.
At any point in time, could we see China really diversifying outside of Australia? Most of these deals have been with Australian companies so far.
That's true, and this partly reflects geographical proximity of Australia, which makes it more attractive to China than, say, Canada or Brazil. Australia being a smaller country is also attractive in terms of China maybe having more leverage here. For instance, Australia ships 80% of its iron ore to China, so the large dependence on the Chinese market gives China some leverage as well. But definitely the Chinese companies have already ventured elsewhere, such as to Africa, and I expect that there will be more geographical diversification going forward.
Dariusz, hi, it's Louisa in London. I know a number of analysts keep focusing in on, hello, I know a number of analysts that keep focusing in on how China can sustain the levels of growth that it's projecting at the moment outside of China if it isn't making sure to stimulate its own domestic consumer. Do we run the risk of building a false asset bubble being led by China in, for an example, buying these basic resource type companies, but in reality the weakness persists on the home front, so it won't be able to continue on this spurt?
I believe that in case of Chinese domestic demand, it's going to continue to expand very fast for a long time to come because consumption is starting from a very low base and because there is still huge needs for fixed asset investments. So it's not going to be a bubble in the sense that China will purchase assets for which it will not have any use going forward. But to the degree that those purchases and direct buying of commodities by China are pushing up global commodity prices, it may be that those prices may get ahead of fundamentals on a global level, because global demand after fiscal stimulus programs lapse in 2010 may struggle catching up to those levels generated by public spending. But in terms of what's happening in China, it will be a major growth story for a long time to come, and they do need those commodities.
Dariusz, this is Mike Huckman in the States, where the IPO market, as you know, has been pretty weak so far this year. But China is seeing a relatively healthy pickup in IPOs, but is there a danger of it being too much of a good thing, that perhaps there's an overestimation of investors' appetite there for new shares?
Well, so far this year, IPOs in China have amounted to about 73 billion renminbi, which is around 11 billion of US dollars. This is still much less than a year ago and about 7 times less than 2 years ago. So I do not think that we are dealing with an overestimation of investor demand. In fact, those IPOs are really very heavily oversubscribed. Having said that, when you look at trends in the secondary market, the level of demand may not be as high later this year as it was in the first 2 months since IPOs were again allowed in June, just because when secondary market is so fragile, investors are not hoping for such big increases in the first day of trading. And for that reason, I don't think that Chinese regulators will allow many more large IPOs of the scale of Metallurgical Corporation of China, which we are seeing being priced on Thursday, unless the secondary market recovers in a sustainable fashion.
All right, Darius, thanks so much for joining us. Dariusz Kowalczyk, there, of course, Chief Investment
Thanks
Strategist at SJS Group.